What is revenue? Revenue is the total amount or income generated by way of selling the goods or services related to company's operations. Suppose company is dealing into some kind of goods, company is producing goods, or other company that is providing services. So when the company sell that goods or when the company provide that services, and in return of that services or goods, when the what amount company is received, it's called its revenue. That is also referred as a top line. Why? Because it sits at the top of the income statement, and that is also called the gross sales of the company. What is cost of goods sold? Cost of goods sold is the direct cost of producing that material that is being sold by the company. So that does not include the indirect cost. That is covers only direct cost. And you can arrive to the gross profit by subtracting the cost of goods sold from the revenue. What is net profit? So net profit is the profit which is left after all the overheads has been taken care of. So net profit can be arrived by subtracting all the cost of doing business from the revenue, whether it is the direct cost or the indirect cost. Or we can say that gross profit minus all the indirect expenses come down to the net profit. What is depreciation? Depreciation means reduction in the value of assets. There are two concepts in the accounting for the depreciation. Number one is that there is a reduction in the value of assets over a period of time due to the wear and tear and the usage of the assets. The other concept is because as we buy the assets for a longer period of time, that is not for a one particular period. Suppose we buy an asset and use for a period of 5 years, then cost of that assets it is to be allocated in between the 5 years. It is not to be charged in the one particular accounting year. So that is why the depreciation concept is there, to allocate the expenses, to allocate the cost to the each period where the assets has been utilized. What is EBITDA? EBITDA stands for earning before interest, tax, depreciation and amortization. It provides investor a snapshot of business operational efficiency as it ignore the impact of non-cash or non-operating factors such as interest, tax and depreciation. What is EPS? EPS, earning per share. So earning per share is the net profit divided by number of shares outstanding of the company. It means how much company is earning for the one share, for each share. What is equity? Equity refers as a shareholder's equity or the owner's capital. That can be arrived by subtracting all the liabilities from the assets. It can also be represented as in case of liquidation, when all the assets are liquidated and all the liabilities and debts are paid off. The balance amount can be returned to the shareholders or the equity shareholders of the company. What is public limited company? So public limited company is a company who can offer its shares to the public. It is often listed on the stock exchange. What is the private limited company? Private limited company means the company who has not given his shares to the public. Private limited company can issue shares but not to the public. It has been issued within the closed group. It can have the private ownership. They cannot trade the shares in the public. They are not listed on the stock exchange. What is debt to equity ratio? Debt to equity ratio is used to evaluate the company's financial leverage, and it is calculated by dividing company's total liabilities by its shareholders' equity, as it reflects that how much capital is available to cover all the company's debt in case of business downturn. What is ROE? Return on equity. Return on equity can be seen by the investor as a measure of company's performance and efficiency. ROE can be calculated by dividing the net income of the company by the equity share capital of the company. What is return on capital employed? ROCE. So return on capital employed is a financial ratio that is used to assess the company's profitability and its capital efficiency. In other words, we can say that how well the company is generating the profits out of its capital. So the formula is return on capital employed is equal to earning before interest and tax divided by capital employed. And so what is the capital employed? Capital employed is equal to total assets minus the current liabilities.